So, back in March of 2026, one single event sent a massive shockwave through the global economy. We're talking jobs threatened, industries grinding to a halt, and it wasn't a bank collapse or another pandemic, it was an oil crisis. In this explainer, we're going to break down what happened, why it happened, and what it really tells us about the fragility of our world.
All right, let's dive right in. And to really get a feel for how big this thing was, we're not starting with maps or geopolitics. We're starting with the immediate and frankly painful hit to the economy.
This quote from a Goldman Sachs analysis really just gets right to the heart of it, doesn't it? The price of oil isn't some abstract number on a screen. When energy costs go through the roof, it hits businesses hard, and that affects their ability to hire, to grow. It's directly connected to people's jobs.
And wow, the numbers are pretty grim. The bank projected that this price surge would slash U.S. payroll growth by about 10,000 jobs every single month for the rest of the year. That's not a one-time thing. That is a serious, sustained drag on the entire job market. Yeah, and it wasn't just about slower job growth either. The unemployment rate itself was expected to creep up. And get this, according to the analysis, you can trace half of that increase right back to this oil shock. It just shows you how deeply tangled energy prices are in the whole fabric of the economy.
So, that brings us to the big question, right? What was the trigger? What on earth could cause such a fast and severe mess? Well, the answer lies in one single, incredibly vital waterway.
Okay, so now we're zooming in on the geographical epicenter of the whole crisis, a single spot on the map that has enormous power over the world's energy supply. This is it, the Strait of Hormuz. The entire crisis we saw in March 2026 started right here, in what is, without a doubt, the world's most important shipping lane for oil. So just for some context, a maritime choke point like Hormuz is, well, think of it like the main artery for the global economy. It's a super narrow passage, really hard to find a way around, and when it gets clogged, or in this case completely blocked, the entire system feels the pressure almost immediately. And this chart, wow, it just lays out how bad the shutdown was. Normally, you've got almost 140 commercial ships passing through there every day. In early March, that number just plummeted to single digits. And the oil tankers, the most important ships of all, their traffic dropped to zero on several days. The artery was, for all intents and purposes, clamped shut.
So with the world's main oil pipeline suddenly offline, global markets did exactly what you'd think they'd do. They freaked out. The reaction was fast and it was brutal, right across the board. The very first place everybody felt the pain? At the pump. This IEA data shows a huge coordinated spike in gas prices in every major global market you can think of, from Europe to the US Gulf Coast to Singapore. Absolutely nobody was spared.
But it wasn't just cars, not by a long shot. The hit to air travel was even more dramatic. Just look at this chart for jet fuel in Europe. Prices didn't just go up, they exploded to a 3.5-year high. And that had immediate effects, grounding flights and throwing travel and supply chains into total chaos.
This disruption then just cascaded down the whole supply chain. Now, this table looks complicated, but it shows something called refining margins. Basically, that's the profit a refinery makes when it turns crude oil into stuff like gasoline or jet fuel. With crude suddenly so scarce and expensive, those profit margins shot up as companies passed all those extra costs onto, well, everyone else.
So the situation is looking pretty dire. A critical supply line is severed, prices are going through the roof, and the economy is sputtering. What could possibly be done to stop this freefall?
The answer came in one giant number, 400 million. In a big, coordinated move, the 32 member countries of the International Energy Agency, the IEA, agreed to release 400 million barrels of oil from their emergency reserves. It was basically a flood of supply aimed at one thing, calming down those panicked markets. You see, these government-held stockpiles exist for exactly this kind of emergency, and as this chart shows, these reserves are spread out all over the world, in the Americas, Europe, and Asia. This isn't just one country's backup plan, it's a collective global safety net. And a massive piece of that safety net is the U.S. Strategic Petroleum Reserve. Holding about a third of all the government stocks, the SPR acts as a huge buffer that can be used to stabilize prices and basically give the world some breathing room during a bad supply shock.
Okay, so while this huge emergency release definitely helped steady the ship, it's really important to put this whole crisis into historical perspective. Because as painful as this shock has been, it's actually fundamentally different from the crippling oil crises we saw back in the 1970s.
That same Goldman Sachs analysis makes this crystal clear. An oil price shock today has only about 1/3 of the negative impact on the U.S. economy that the same shock would have had back in the 70s or 80s. To put it simply, the economy has built up some serious armor. And this newfound resilience really comes down to two gigantic structural changes. First, our economy is just way more energy efficient now. We use a lot less oil to produce $1 of GDP. And second, the U.S. isn't just a consumer anymore. The shale boom has turned America into a massive energy producer, and that acts as a natural shock absorber when global prices go crazy.
So here's the paradox this whole crisis leaves us with. Our economies have built up these powerful financial and domestic shields against price shocks, but the physical world, the map itself, hasn't changed. Our global system still depends on a handful of narrow, fragile waterways. We've gotten better at surviving the shockwave, sure, but this was a powerful reminder that we've done very little to prevent the earthquake itself. So the question isn't just if we're prepared for the next shock, but what happens when a choke point closes, and this time the safety net isn't big enough?